Is Britain heading for another financial crisis? The pound is tumbling, government borrowing costs are spiking, and investors are starting to ask the question, can the UK still be trusted with its finances? At the same time, we face a deeper challenge. London is carrying too much of the weight, and cities like Birmingham and Manchester are only now catching up. So in this video, I'm going to unpack it all. We'll look at why the markets are so nervous, why inflation here is proving so stubborn, and why our economy cannot rely on London alone. Stick with me, and by the end you will see exactly where the UK economy might be heading. Let's start with bond yields. Sounds technical, right? But it's pretty simple. Bond yields are the interest rate the government pays when it borrows money. And right now, the UK 30-year bond yields are at the highest since 1998. That's a generational high. That means every pound the government borrows is more expensive to service. Back in 2022, Liz Truss's mini budget caused a market panic, with UK yields shooting above every other country in the G7, and those scars still haven't truly healed today. Now let's fast forward. Labour plans for more spending and investment, which in theory sounds great, but in practice, not so much. Yields are again beginning to creep higher. But here's the nuance. In 2024, UK yields as a percentage have risen less than Germany or Japan. But our problem is the level. We're already starting from a higher benchmark. And if your borrowing costs are structurally higher and you keep adding more debt, eventually the maths stop working and the economy goes into meltdown. That's why markets are worried today. And it's not just bond yields. The pound recently fell sharply against the US dollar. That combination of high yields and weak currency is toxic. It means higher borrowing costs and less purchasing power abroad. So what's driving this? Well, it's inflation. UK inflation is still running hotter than most of our G7 peers. And food inflation is around 5%. Families are still squeezed every week at the local supermarket. Compared to Europe or the US, Britain is an outlier, and as long as inflation stays above the Bank of England's 2% target, the markets assume rates will stay higher for longer. That's the root of the nerves. Sticky inflation, high borrowing, high costs, with no quick fix in mind. So what does this mean for the Chancellor, Rachel Reeves? She faces one of the toughest fiscal tests in decades. Here's the box she's trapped in. She can't really cut public spending. Politically, that's impossible. She can't abandon the fiscal rules. The bond market won't allow it, which leaves her one lever, taxes. But Labour already promised not to raise VAT or income tax and have already raised national insurance. As the former CBI chief puts it, those pledges are now outdated. The Office for Budget Responsibility is also expected to downgrade productivity forecasts. That means even less growth, less tax revenue, and a bigger funding gap, perhaps 20 to 40 billion pounds. And here's the scary part. If productivity really undershoots, debt could explode. Some projections put it at 647% by 2070. That's uncharted territory outside of war. It all boils down to this. Without stronger growth, Britain's fiscal path is unstable. When we talk about the UK economy, one thing is clear. Growth depends on development, fresh investment, more housing and smarter regeneration. This all starts with land. And that's exactly what our sponsor Landstack helps with. It's an all-in-one mapping and sourcing tool that lets you track planning applications and use government and national data to help you spot hidden opportunities. If you want to be part of Britain's growth story, check out Landstack today at landstack.co.uk. And here's where we get to the structural problem. London is extraordinary. It contributes around 23% of UK GDP, but no country can rely on just one city. The UK is one of the most regional, unequal economies in the developed world. London and the South East thrive, but much of the Midlands, the North and Wales lag behind. There are signs of change. Take Birmingham. United capital with NFL legend Tom Brady bought Birmingham City Football Club. But it's not just football. It's a £3 billion regeneration project. New stadium, housing, offices, transport links. With HS2, Birmingham is effectively London Zone 5, just 47 minutes away. Manchester too has benefited. Local leaders making local investment decisions. And in the past decade, Greater Manchester has been one of the fastest growing regions in the country. The latest ONS data tells the story. In 2023, London grew just 0.2%, but the North East grew 1.7% and the West Midlands grew 1.1%. The balance is beginning to shift. So where does this leave us? Short term, the picture is rough. Bond yields are high, the pound is weak, inflation is sticky, and the chancellor is boxed in. But long term, there is hope. If Britain can raise productivity, empower regional cities, and build a more balanced economy, debt can fall. Growth can return, and confidence can be restored. But it will take political will, because London alone can't carry Britain anymore. For the UK economy to thrive, we need the whole team on the pitch. So is the UK on the brink of crisis? Well, not yet, but the warning lights are on. Markets want a credible plan, families want inflation down, and investors want growth across the whole country. That's the challenge and also the future opportunity. Now, if you found this breakdown useful, hit like, share it with someone who's been asking about the UK economy, and don't forget to subscribe for more deep dives into property, politics, and economics. I'll see you in the next one.